Your next top performer probably lives in another country. Companies today can hire talent from almost anywhere in the world. The boundaries of the office have dissolved, replaced by a truly global marketplace for skills and expertise. But while the technology to collaborate globally has become simple and intuitive, the legal and operational side of international hiring remains a complex puzzle. Every country has its own employment laws, payroll regulations, tax systems, and worker classification rules. These are not just administrative hurdles, they are fundamental legal requirements. Because of this, companies must choose how they structure international hiring, not just who they hire. The structure defines your risk profile and operational efficiency. In this video, we'll explore the major structures companies use to build global teams and the advantages and risks associated with each unique approach. When a company hires an employee domestically, the legal framework is relatively straightforward. The rules are known, the language is clear, and the infrastructure is already in place. The company is the legal employer. Payroll taxes are withheld and remitted locally, and employment laws follow a single, unified jurisdiction that the company is familiar with. But moving beyond borders introduces layers of complexity that can overwhelm even seasoned HR and legal departments. It's a different game entirely. Companies must comply with specific local labor laws. This includes everything from mandatory notice periods for termination to statutory severance pay requirements, which vary by seniority. Then there are payroll tax systems and Social Security contributions. In many regions, these contributions are significantly higher than what domestic employers might expect, impacting your total cost of hire. Mandatory employee benefits also vary wildly, from healthcare in the US to 13th month pay in parts of Latin America and the Philippines. These are non-negotiable legal obligations you must factor in. Finally, government reporting requirements. Each country establishes its own rules for how and when you must report employee data, often requiring specialized local knowledge to avoid audits. The first model is the independent contractor. This structure is highly popular for its speed and flexibility, especially in consulting, technology, and specialized project-based work. In a legitimate relationship, the individual operates an independent business. They often work with multiple clients, control their own schedule, and provide their own tools and equipment. You pay an invoice for services rendered. However, intellectual property ownership must be explicitly defined. Many countries do not recognize work-for-hire clauses in B2B contracts. To protect your core assets, you must include explicit IP assignment clauses that are legally enforceable under the specific local laws where the contractor is physically located. If authorities decide a worker is an employee, you could face massive back tax liabilities, statutory fines, and legal penalties that far outweigh any initial cost savings. The second model is the employer of record, or EOR. This is the preferred strategy for companies that want to hire full-time employees in new countries without setting up an entity. In this model, the EOR acts as the legal employer. They already have the local entity, the tax registrations, and the bank accounts ready to go, allowing you to hire in days. The EOR manages the formal employment relationship. They handle local employment contracts, payroll processing, and complex tax withholding and remittance on your behalf. They also ensure full compliance with local benefits like health insurance and pensions, shielding you from many direct legal liabilities while providing a professional experience for the worker. Critically, while the EOR is the legal employer, your company continues to direct the employee's work, performance expectations, and day-to-day business activities. They are truly your team. Many companies use EORs to offer global equity or stock options, but navigating the tax implications of grants for international employees is notoriously complex and risky. From phantom stock to RSUs, the local tax treatment of equity varies significantly. An EOR provides the necessary framework to manage these complex reporting requirements accurately. Model 3 is the traditional approach, establishing a local legal entity. This usually means setting up a subsidiary or a branch office in the target country. By establishing an entity, your company becomes the direct legal employer. This provides the highest level of operational control and long-term brand stability in the local market. However, the administrative burden is significant. You must manage corporate registrations, local tax filings, and comply with local government audits directly, which requires local expertise. In many countries, setting up an entity requires a resident director and a physical office address. These substance requirements add layers of cost and logistical complexity. Because of these requirements, companies usually only transition to this model once they have a proven business case and a significant headcount in that specific country to justify the overhead. A key factor in the entity decision is permanent establishment risk. This is the danger that a local government will decide your business activities have created a taxable presence. If you trigger PE risk without having an entity or an EOR, you could be liable for corporate income taxes on profits generated in that country, creating a massive financial hit. Model 4 is global payroll infrastructure. This is the nervous system of your global operation, coordinating payments across dozens of different regulatory environments. Global payroll must coordinate multiple currencies, ensuring that employees are paid accurately and on time, while managing exchange rate volatility and treasury management. Your payroll systems must also navigate cross-border tax treaties. These treaties prevent double taxation for your employees, but applying them correctly requires sophisticated compliance engines. In recent years, many governments have introduced digital reporting systems. These require employers to submit payroll information electronically, often in real time with every pay cycle. You must also account for Social Security totalization agreements. These international treaties are designed to prevent you from paying social taxes in two countries for the same worker. Data privacy is another major factor. Your payroll infrastructure must be fully compliant with regulations like GDPR in Europe or CCPA in California, protecting sensitive employee information. As a result, global payroll has become one of the most specialized and technically demanding functions within modern international workforce management. Accuracy is non-negotiable. Data privacy isn't just about GDPR. You need robust, encrypted channels for transferring sensitive payroll and banking data between your global HQ and local government agencies. In practice, most successful companies rarely rely on just one structure. Instead, they use a strategic mix depending on the specific needs and maturity of each local market. A company might engage independent contractors for specialized, short-term consulting while simultaneously hiring full-time staff through an EOR to build a core regional team. Once they reach a critical mass, say 50 or 100 employees in a country, they transition those workers from an EOR to their own local legal entity for better economies of scale. The challenge is orchestrating this. Your HR systems must provide a unified view of your diverse workforce, contractors, EOR employees, and direct hires, all in one place. Over the past decade, the strategy for global expansion has flipped. Historically, you built the entity first and then looked for people. Today, companies find the talent first. They use EORs to secure the best minds in the world immediately, following up with entity creation only when the business case is proven. This talent-first approach also requires a strong global employer brand. You must be able to offer a consistent, high-quality employee experience regardless of the legal structure used. But remember, successful global hiring requires more than just great recruiting. It requires a deep understanding of the frameworks that govern international employment and tax. If you want to learn how companies are building teams without borders, subscribe and like our videos to follow the Global Hiring Guide series. If it has helped you in your current activities, please share it, as this will help us bring more quality content to you. See you in our next video.